Welcome to the Deep Dive. Today, we're taking a deep breath and wading into the world of financial reporting.
A world that looks very black and white.
It really does. I mean, you look at an income statement and every single figure is neat, clean, often down to the penny. It looks like absolute, undeniable fact.
And that appearance of precision, that's really the biggest illusion we have to get past. Our sources are very clear on this. Financial statements are a product of both math and a whole lot of human judgment.
Which means they can be imperfect.
Inherently imperfect. The goal of all this reporting isn't to produce one single perfect truth. It's to create what's called a fair presentation, something that's reliable enough to be useful for making decisions.
Okay, so if they aren't a perfect mirror of reality, we need to understand where they can break. What kind of distortions are we talking about? And I guess, how often does the whole system that's designed to keep it all honest actually fail?
That's the mission. And to really get the safeguards, you first have to understand the vulnerabilities. The sources give us a really useful framework here. They say all the problems, everything that can go wrong, falls into one of three buckets:
And those are?
errors, disagreements, and fraud.
Okay, let's start with the simplest one then. Type 1, errors. These are just honest mistakes.
Exactly. Unintentional slip-ups. They happen during the accounting process because, well, it's complicated. It could be sloppiness, a miscalculation, bad information.
Right. The sources have some really relatable examples. Things like an invoice gets lost in the mail, so an expense just never gets recorded.
Or a simple typo. A $500 transaction gets keyed in as $50.
Happens all the time.
But the really big ones, the ones that can materially change the numbers, are often about classification. A classic error is taking a huge capital expenditure.
Like buying a new machine for the factory.
Right, say a $10 million machine, and accidentally recording it as an immediate operating expense.
Wait, hold on. Why is that such a big deal? It's still an expense, right?
It is, but it's about when you recognize it. That machine is an asset. It's supposed to be capitalized. You only expense a small piece of it each year as depreciation.
Ah.
If you expense all $10 million at once, you've just mistakenly wiped out your profit for the entire year. It's a massive distortion, but it's still just a mistake. There's no malice there.
Got it. Okay, that makes sense. But then we get to type 2, disagreements. And this is where it feels like we leave the math classroom and, I don't know, walk into a philosophy seminar.
That's a great way to put it, because it's not about mistakes anymore. It's about judgment. This is probably the hardest thing for people to grasp about accounting. It's full of projections about the future.
So a disagreement is just two reasonable, smart people looking at the same facts and coming to different conclusions.
Precisely. Honest differences in estimates. Think about a huge building. You have to estimate its useful life to calculate depreciation.
Is it going to last 40 years or 50 years?
Exactly. And that guess, that single estimate, directly changes your reported profit every single year, and both 40 and 50 years could be perfectly reasonable, honest answers.
Okay, I see that. And another big one is estimating how many of your customers just aren't going to pay their bills.
A huge one. The allowance for doubtful accounts. Or, for a construction company, estimating the percentage of completion on a 5-year project. All of these require a judgment call.
So type 1 is carelessness. Type 2 is honest debate. Which brings us to type 3, the really destructive one, fraud.
This is the intentional breach of trust. It's deliberate deception, it's outright manipulation of the books, and it's always motivated by something like greed or just intense pressure.
And this is where we get those infamous names that, completely shattered public confidence. WorldCom, Enron.
Right. They weren't making mistakes, and they weren't having honest disagreements. They were building elaborate, intentional lies.
WorldCom. That was the one where they were capitalizing expenses, right? Just like that error we talked about, but on purpose.
Exactly. They took their normal, everyday operating costs like fees for using phone lines and deliberately called them long-term assets. It illegally boosted their profits by billions.
And Enron.
Enron was a masterclass in hiding things. They used these incredibly complex off-balance sheet entities, these special-purpose vehicles, specifically to hide billions and billions of dollars in debt from everyone.
Okay, so we've got the spectrum, mistake, disagreement, and lie. But I want to zero in on that middle ground because that feels like the weak point. Why is accounting so full of these subjective judgment calls?
It all comes down to the foundation of modern accounting, which is something called accrual accounting. It's not just about cash in, cash out.
Right. It's about recognizing revenue when you earn it.
When you earn it, not when the cash shows up. And you recognize expenses when you incur them. The moment you do that, you're no longer just recording history, you're forecasting the future.
You have to estimate if you'll even get paid for that sale you just made.
You have to. So let's go back to that landscaping contract example.
Hmm.
A company has a $10 million multi-year job.
Yeah.
At the end of year one, management has to book some revenue.
So they send a manager out to the site.
Right. And they have to ask, is this job 25% complete? Or is it maybe
Yeah.
75% complete? An objective manager might say 50%.
Which means they book $5 million in revenue.
$5 million. But what if that manager is under crushing pressure to hit an earnings target? Maybe they stretch that judgment. They find a way to justify saying it's 75% complete.
And that's not a small change. That's an extra $2.5 million in revenue and profit. Created out of thin air. Just based on a judgment call.
It's how a required estimate gets weaponized by intent. It's the same thing with bad debt. If management knows their customers are struggling, but they keep their estimate for uncollectible accounts artificially low,
They make their assets on the balance sheet look bigger.
and they lower their expenses on the income statement, it's a double win that makes the company look way more profitable than it is.
So it's clear these judgment areas are the exact intersection. They're where honest disagreements happen, but they're also the exact spot where fraud can creep in. The system needs flexibility, but that flexibility is also the vulnerability.
Which leads us right into fraud itself. It is, by far, the most damaging problem because it erodes the basic trust that markets need to even function.
So let's get into the psychology of it. Why do people do it? We hear about this fraud triangle.
Right. The motives really boil down to three things: pressure, opportunity, and rationalization. The pressure is usually intense.
Like what?
Well, a big one is needing to secure financing, lying to a bank to get a loan or to attract investors. And of course, there's just plain old personal gain.
Inflating the numbers to get a bigger bonus.
Or to make your stock options worth millions. If your stock vests at $2 a share and you're only at $1.90, the pressure to find that extra 10 cents somewhere, anywhere, must be absolutely immense.
And for public companies, it's all about Wall Street, isn't it? Meeting those quarterly earnings expectations.
It's the most powerful driver. Missing your earnings forecast can be catastrophic. The stock gets annihilated, management could get fired.
Okay, so that's pressure and opportunity. But the third part of that triangle, rationalization. That's the really interesting psychological piece. How do they justify it to themselves?
Rationalization is the story they tell themselves. It's the little voice that says, I'm just borrowing this, I'll fix the numbers next quarter when sales pick up. Or, these accounting rules are stupid, they don't reflect our true value, I'm just helping the market see the truth.
Wow. So it turns lying into, what, a temporary fix or even a moral crusade?
It neutralizes the guilt.
Okay, so let's talk mechanics. There are two major types of fraud.
That's right. The first is what we call misappropriation of assets. But what it really means is stealing.
Just theft. Taking cash or inventory from the company.
Simple theft. But the tricky part is covering it up. You can't just take $20,000 in cash because the books won't balance.
So how do they hide it?
Usually by creating a fake expense. The embezzler takes the cash, then creates a phony invoice for, say, consulting fees. Cash goes down, but an expense goes up, so the accounting equation still balances perfectly.
And that's why you don't have the same person authorizing payments and also recording them.
Exactly. Separation of duties is the core defense against that.
And the second type of fraud, the one that costs shareholders billions.
That's fraudulent financial reporting.
Yeah.
This is the big one. It's top-down deception, where senior management deliberately lies on the financial statements to mislead everybody.
This is the Enron playbook, overstating revenues, hiding expenses.
Hiding entire mountains of debt. It's a full-scale orchestrated deception. The amount of intellectual energy they spent at Enron just to maintain the lie was staggering.
It's pretty chilling to think about, which brings us to, I think, the most important part of this whole deep dive. If all these vulnerabilities exist, what stops this from happening all the time? What are the safeguards?
The system has to be multi-layered because no single defense is perfect. And the very first line of defense is, believe it or not, ethical. It's the simple fact that most managers, most accountants, they're honest people.
But you can't build a global financial system just on hoping people are good. So what are the actual mechanical controls inside a company?
The accounting system itself is designed with them built in. We just mentioned separation of duties. But there are also things like required approvals for large transactions, regular reconciliations, All these little procedural hurdles are there to prevent both errors and fraud.
And there's also just reputation, right? The company itself doesn't want to get caught lying.
Absolutely. Self-regulation is a huge motivator. If a public company gets exposed as a fraud, its credibility is destroyed instantly. That loss of trust in the markets is often a death sentence.
Okay, but the big one, the external check that everyone relies on for public companies, is the external audit.
The independent auditor. Their role is absolutely critical. They're the outside experts hired to come in and provide reasonable assurance that the statements aren't materially misstated.
And they don't just check the math. They're supposed to challenge those judgment calls we talked about.
That's their job, to push back on management's estimates. They don't just take the CEO's word for it that a factory will last 50 years. They look at industry data, they look at maintenance records, they challenge those assumptions.
So they're actively looking for evidence that contradicts what management is saying.
Yes. They're testing the internal controls to deter theft, and they are critically examining all those subjective gray areas, the estimates, the revenue policies, to sniff out bias and outright fraudulent reporting.
And what if everything fails? The internal controls fail, the auditors miss it. What's the last final backstop?
Then you get the brutal 1-2 punch of market punishment and legal enforcement.
The market is fast.
The market is an executioner. The second that fraud is even suspected, billions of dollars in company value can be erased. In minutes, shareholders get wiped out.
And that's just the financial cost. For the people who did it, there's a huge personal cost.
A huge one. Fraud is a crime. We're talking career-ending disgrace, massive fines that bankrupt you, and serious prison time. The fear of ending up like the executives from Enron is a very, very powerful deterrent.
It really is amazing when you think about it. You have all this pressure, all this subjectivity, all this opportunity, and yet most of the time, financial reports are pretty reliable.
They are, because that whole system, the ethical baseline, the internal controls, the external audit, and the very real threat of prison, it actually works most of the time.
So after all this, what's the big takeaway for you, the listener, who has to use this information?
I think the key is to become a more sophisticated user. Understand that the numbers aren't gospel. They're the output of a system that is full of human judgment. And if you understand the potential for errors, disagreements, and fraud, you can read those statements with a much more critical and, frankly, intelligent eye.
The integrity isn't really in the numbers themselves. It's in the people and the systems behind them.
That's it, exactly.
And that leaves us with a final thought for you to chew on. If the whole point of accounting is to create useful information, and that requires all these subjective estimates about the future, how much flexibility does a management team ethically get before an honest disagreement about an estimate crosses the line and becomes an intentional deception?
That line between type 2 and type 3, it's often completely invisible from the outside. But the only difference in the end is intent.
A powerful place to leave it. Thank you for walking us through all of this. It's critical stuff.
My pleasure.
Until next time, keep digging into those sources.